the Monetary Policy Committee voted to increase the policy repo rate by 40 basis points.
I'm sure many of you might have heard or might have read this news. The Reserve Bank of India has raised the repo rate by 40 basis points to 4.04% and the cash reserve ratio by 50 basis points to 4.50%. While the repo rate hike will come into effect immediately, the CRR hike would be effective starting May 21st, 2021. So in this video, we are going to understand what exactly is RBI's repo rate hike, why was this decision taken all of a sudden, what impact does it have on you as a borrower, and should you really worry about it? So what is repo rate and how does it work? Well, when you borrow money from the bank, the transaction attracts certain kind of interest on the principal amount. This is referred to as the cost of credit. Similarly, when the banks face any kind of cash crunch, then they borrow money from the RBI on which they are required to pay interest to the central bank. This interest rate is called as the repo rate. Technically, repo stands for repurchasing option or the repurchasing agreement. It is an agreement in which the banks provide eligible securities such as the treasury bills to the RBI while availing the overnight loans. So why was this decision taken all of a sudden? Well, RBI's decision to increase the repo rate by 0.40% was taken keeping in mind the rising inflation, geopolitical tensions, higher crude oil prices and shortage of commodities globally which have impacted the Indian economy. So you might pose a question, why was the CRR raised too? Well, excessive liquidity in the system results in higher inflation and the RBI has been trying to suck out liquidity through various other tools in the previous policies. The hike in CRR by 50 basis points is yet another move towards this end. The central bank has stated that rupees 87,000 crore of liquidity will be withdrawn through this move. To put it more simpler, if the RBI wants to infuse more liquidity into the system, then it lowers the CRR and leaves the banks with more liquidity to lend. While on the other hand, let's say if the RBI wants to suck out some liquidity from the system, then it decides to increase the CRR rate. So now let's understand what does this move mean to the banks or the lenders and how is it going to impact your EMIs and deposits. Well, the hike in repo rate, which is the key policy rate of the RBI or the rate at which it lends to the banks, means that the cost of the funds for banks will go up. This in turn will prompt the banks and the NBFCs to raise the lending and deposits rates in the coming days. To talk about how is this going to affect you, then let me tell you now both the existing as well as the new retail borrowers will have to pay higher equated monthly installments or the EMIs for their home loans, vehicle loans and other personal and corporate loans. With this move, the floating rate loans will get costlier while all the new loans are likely to be priced higher. Well, let me tell you that the EMI of the floating rate loan changes when there is a change in the market interest rates. If the market rates increases, let's say for instance, then the repayment also increases. And when the rates falls, the dues also falls. The increase in repo rate will affect all the retail floating rate loans. So let's understand this with an example. Suppose you are an existing home loan borrower and you have taken a loan amount of say rupees 30 lakhs for a tenure of 20 years on an interest rate of 6.8%. In this condition, you might be currently paying the EMI of rupees 22,900. With the implementation of the new rates, the interest rates have been hiked to 7.15%. So now you're required to pay the EMI of rupees 58,825, which is a hike of rupees 1,798. Now let's understand what will it have an impact on other loans. Well, personal and auto loans typically attract fixed rates. For those who have already taken these loans, there's nothing to worry about, as the EMIs and the interest rates would remain the same. However, the loans with the floating rates will become costlier, as will the new loans. Well, this is not all. While the interest rates on term loans such as house, cars and other personal among others are seen to get higher during a rate hike, this is opposite for deposits as they seem to become more attractive with interest rates getting higher during the rate hikes, giving hefty returns to depositors on their investments in traditional schemes, especially in fixed deposits, which are less riskier when compared to other market instruments and also offers guaranteed returns. Thus, there is a further room for more hikes, which is likely to lead to a rise in demand for FDs. So should you really worry about the RBI's announcement? Well, the last time there was a change in repo rate was in May 2020. The lending rate was cut then and has remained unchanged since. The repo rate has been hiked for the first time in the last 4 years. It was last increased by 25 basis points to 6.50% in August 2018. Let me tell you, the RBI decides periodically whether to hike or slash the rate or leave it unchanged. The repo rate is a very important tool for the RBI to control inflation trends. Raising or cutting the rates by the RBI will make borrowing more expensive or cheaper for the commercial banks. The repo rate and inflation have an inverse relationship. If the rates increased, then it will bring down the inflation, and if the rates are lowered, then the inflation will go up. Thus, there is absolutely nothing that you need to worry about. So, it's advisable that you do not react with haste and you wait for your respective banks to communicate you the right details. So, this was all about the RBI's repo rate hike and what it means to the borrowers as well as the banks, and should you really worry about or not. For more such updates on what's going on in the financial world, you need to subscribe to our channel, and do not forget to hit on the like button, and also do not forget to hit on the bell icon to get notified for our next video. Thank you for watching IndianMoney.com. Get wise, break free.